So look, I think this is just a bit of cooling off of a crazy run that we've had over weeks. So I wouldn't be too concerned about that. I think more importantly, that what we've seen is a de-risking of the macro environment as inflation has just come down. We've had a veritable miracle happen in terms of the supply side of the economy, which has led inflation to come down without sacrificing growth. And that just de-risks the outlook for us, and the Fed shifting towards that, easing already without signs of trouble on the growth side, is like spraying foam on the runway. So if you're worried about any kind of a bumpy landing, we're already spraying foam to prevent as much damage as we were fearing earlier on.
The market's expectations continue to change around the rate cuts, but we're pretty much still at about 150 basis points, which is double what the Fed is guiding the market. If we don't get the rate cuts that are anticipated already, we're having a conversation that you've got a number of more hawkish members that are voting members over at the Fed this year. If we don't get the rate cuts, what does it mean in terms of how far the market has already accelerated in 2023 based on rate cuts?
Yeah, so I'd say that both the equity market and the rates markets did run ahead of themselves in the last few weeks of the last year, and we're due to see a bit of a retrace of that, because we don't think you're going to get 150 basis points of cuts, and the market needs to price some of those out, and the equity market needs to adjust valuations as a result of that as well. That said, I think weakness that we see would be buying opportunities to be adding risk because of what I was saying about the risks now are much lower than they were before. So yes, we've got ahead of ourselves pricing wise, but the actual prospects for the fundamentals don't look so bad.
Why don't I disagree with you? Just to have a bit of sport this morning. Here you go. I really disagree with you. I think you're 100% right with de-risking the macro environment in one area, and that is Western inflation, which appears to be tame. But if we look at Eastern inflation in China, we have a problem with deflation. If we look at the macro environment, we have all kinds of geopolitical hotspots which remain incredibly problematic. We have vast numbers of important democracies around the world which could throw up some really extraordinary and worrying scenarios. And I'm not talking about the States necessarily, I'm talking about the European parliamentary elections, I'm talking about elections all around the world as well. So I agree with you in terms of there is a de-risking of the inflationary concerns, and the Fed appears to have done the impossible, which is raising rates so aggressively without breaking something, but appears to, I'd say, at this stage. But I'd say elsewhere, there is risk aplenty.
Look, I would agree, but prices are also reflecting that to a large extent. You see this huge divergence in terms of what the market's already built into those prices for the US relative to the other, to these other hotspots. So in general, our capital market line assessment is that you're not paid that well to take that additional risk at these kind of price levels. So the backdrop itself, in terms of the fundamentals, look relatively okay to us. But in terms of return potential, that's where I probably agree with you, that it's less exciting than it was last year.
Okay.